Welcome back to Great Quarter, guys. This is episode 56, the show where the lines between freight and finance are none. I'm your host, Andrew Cox. I've got Seth home with me as well. Today, we've got a cool show. We're going to talk about Containergeddon, and through the lens of Containergeddon, through Peloton and its major shipping delays that many customers are complaining about. There was a recent New York Times article that highlighted a lot of those delays and a lot of the complaints from customers. So we're going to take a look at Containergeddon and the big congestion we have at pretty much all of the U.S. ports, but especially that of LA and Long Beach through the lens of Peloton. But before they do that, we're going to do You Care or Nah. I've got 5 You Care or Nahs for us today. But then right before that, I'm going to do a reprisal of a segment that I did back in March and April when COVID-19 was really rampaging across the country. I did a piece that I called One Good Piece. And that was me trying to find one good piece of economic data or financial data that is good, that gives us something to look forward to. And we have a great one here, a recent research from Goldman Sachs. And this is on the impact that the vaccines are having on hospitalization rates. And it's having almost an immediate impact. So from September to early January, U.S. COVID-19 related hospitalizations grew at a rate of 1% per day. If this trend held, hospitalizations would have been up 12% over the last 12 days. Instead, hospitalizations have declined by over 7% during this period. So you can see this in this dark blue line. That is the hospitalization rate, the current hospitalization rate in the US. After the first week of vaccines, you really saw an immediate impact to the hospitalization rates. And that's because of who they're prioritizing with these vaccines. That is the long-term care facilities mostly. But the good thing is we're having an immediate impact, and this is great. And we're expecting the states and also the other impact that we've seen here is that states with high vaccination rates have seen even larger declines in hospitalizations, according to this Goldman Sachs data. Seth, let's bring you in here, man. When you see this, what gets you most excited? What comes to mind?
I think it's just great news. I mean, it's the beginning of the end of a long period of time. Looking at that graph, it should still be up there. I mean, if it weren't for those vaccines, we'd be on that sort of light blue line. But given the rate of hospitalizations and the winter weather, we might have actually been at the +1 standard deviation, that dotted line. So I think it's great news. I think it's what economists and investors like to call green shoots. I think this is why people are getting excited about economic growth in the second half, because you're already starting to see material effects, and that's 14 days after only a few 100,000 people have been vaccinated. Might have my numbers wrong there, but
yeah, I think it's a few
tell that curve is starting to break downward, which is great news.
Yes, exactly. Great news. So that is our one good piece for the day. So let's get into You Care or Nah. So Seth, I'm going to give you an event, a topic, or an idea, and you tell me whether you care or nah and why. So the first one is entrepreneur who ran Walmart Inc.'s counterattack against Amazon is leaving the retail giant after 5 years. Seth, you care or not?
Surprisingly, I'm going to say I don't care on this one. Okay. I think MArc Lore was great. He was instrumental in kind of turning Walmart, more so into a tech and an e-commerce company. However, he has not even been, as that Wall Street Journal article talks about, they had a U.S. president of e-commerce that he was reporting to, and I think that MArc Lore, he had a 5-year, $250 million earnout that he had to stick around for. So I think the timing makes sense now that he's getting fully paid out. I'm sure he wants to do other things, and when you're worth a couple $100 million and you're no longer the CEO, a lot of times people do want to do other things.
So you don't think there is anything more to read here, that as soon as the contract was up, he bounced? It's just, a serial entrepreneur with now even more money than he had before, ready to go out and get back to doing what he does best?
Yeah, I mean, if you mean, I don't think there's like an earnings bomb or a massive deceleration or red flags in e-commerce. I mean, I think e-commerce for Walmart is about $15 billion run rate, and it's growing, 60% or thereabouts. So And in fact, I think with all the stimulus checks that Walmart is likely to see accelerating growth. And plus, he's sticking around through September in an advisory role on the board. So, that kind of shows you there's probably no bad blood or anything like that.
Right. Yeah. He said he was going to continue to be a champion for the brand, even when he's not being paid by Walmart. He said that his goal initially was in 5 years to change the internal and external narrative about Walmart, about e-commerce, and about Walmart as a tech company. And as you said, I really think he succeeded in that role. I mean, now, Walmart hasn't really been repriced so much as a tech company the way that, Amazon or other competitors in e-commerce have, but they're getting, there's room to run to where we think that they may in the future. And he said that his 5-year goal was achieved. He achieved most everything that they wanted to do, and said that Walmart was ahead of schedule. But I do want to point out that not everything he did was successful. They did go out and acquire a bunch of digitally native brands that didn't exactly pan out, and he admits to that fault. But overall, I think he's done an amazing job. I do care about this one. I didn't say I do care because I think he'll be sorely missed. I'm also excited. You mentioned when we were off the line about his next venture. He says he wants to build the city of the future, which it must be nice to be that rich and be able to do something like that. But yeah, either way, MArc Lore headed out of Walmart. We'll see what the implications and the fallout of that are in the coming months. But he's done what he needs to do. All right, so the second one is another EV SPAC, yet another. This one is Lion Electric. Each one of these EV SPACs seem to have a little bit of a twist. This one is mainly focused on electric school buses, although they do have some urban vehicles that are Class 6 and Class 8 or Class 7 trucks, as well as some refuse trucks. But this company, the merger will finalize sometime in the first quarter. Seth, you care or not about Lion Electric?
I care about this one, and I brought this one to Andrew, Mr. SPAC Cox here. I thought it was interesting because, this one is more interesting because with the government as your customer and the Biden administration wants to have, 500,000 electric school buses by 2030. I think that given the nature of those contracts being from the government, I think it's a more exciting story. And then they've also got Amazon. So Amazon, I think, has an investment and has ordered, I don't remember the exact number, but I want to say about 100,000 electric vans from Rivian. But they've also Lion Electric has a pipeline of 2,500 electric delivery vans that they've also committed to Amazon. So I think it's a pretty good story between the electric delivery vans and the school buses.
Yeah, I agree. They are the leader in electric school buses, but this is the thing here. They've only got 300 or so on the road. So it kind of tells you that we're such in the early development of this change in this space. And for competition wise, it's pretty much an oligopoly. They've got Bluebird, the traditional school bus that I grew up riding on. You've got the divisions of Navistar and Daimler. Those are pretty much the only competition besides Lion. And it's a pretty big market, and it seems to be growing. I read that the market is for new school buses, about 45,000 new school buses per year, at about 10 billion in revenue per year. So that's expected to accelerate too with this new purchase plan that the Biden administration has put in their clean energy bill. And the last thing I wanted to note is that this space seems to be heating up. Not only the EV market, of course it is, but the EV bus market in particular. I saw just last week, Chamath Palihapitiya is going to lead the funding round for Proterra, who is the leading electric commercial bus or residential bus rather, that does city commutes. So the space is heating up for electric buses. There's going to be more to come, I'm sure, but it's an interesting time to be watching it. All right, so number 3. So this one is on an import ban that the Trump administration implemented at the end of last week. It is a ban on cotton and tomato products from the Xinjiang region of China. This region produces 85% of China's cotton, and China accounts for 20% of the world's cotton production. Seth, what do you think? Do you care or not about this ban on cotton and tomatoes?
I do care about this one, and I learned about this one from your retail point of sale newsletter. I think it was on Saturday or something. So I read that, and I'm sort of embarrassed to say that I had not heard. I knew China was big in cotton, but I hadn't heard of this specific province. But it makes sense. Supposedly they're employing refugees and that sort of forced labor and those types of things. So I think it hits on a greater theme, as you touched on in your newsletter, which is consumers aren't going to allow companies to feign ignorance that with regard to their supply chains, with ESG growing in terms of investing and importance of investing. And it also has a lot of implications for freight tech, because if you want to know where you're sourcing things, how it's moving through the supply chain from point A to Z, you're going to have technology. So, but I do think it is sort of it's bigger in terms of the message that it sends than the actual cotton.
Yeah, I agree. Mark Morgan, the acting commissioner for the Customs and Border Patrol, said in a statement that the order will send a crystal clear message to the trade community to know your supply chains. And that's a really important point here, is that a lot of these companies have known about the atrocities that's happening in this region, but they don't even have enough visibility into their supply chain and don't get enough visibility from their Chinese suppliers to have any idea whether their goods are made with cotton or tomatoes from the region. So a lot of people have tried to sever ties and have not been able to. So I think there's going to be more and more that are leaving this area, obviously. But as you said, this is a very important topic to them. I read a recent survey that 87% of customers say that fair labor practices and trade practices are important to them when they're purchasing products. So not only is the government that's going to be pressuring them, but it's going to be consumers as well. All right, so number 4 is on a merger. We've got Fiat Chrysler and the PSA Group out of France that have finalized a merger to create a new company called Stellantis. It began trading in the U.S. today. Here are the 13 brands that now make up the parent company, Stellantis. Seth, what do you think? You care or not about this merger?
Yeah, I mean, I think you have to care here. This is now the 4th largest car company in the world on a combined basis. They do more than 8 million units a year, and they've got some iconic brands in there with Fiat, Chrysler, Jeep, Peugeot, Citroën, Vauxhall. It's a big, important brand. And, I think I was reading that the CEO of Peugeot is going to lead the combined company. And they're sort of forecasting some huge cost synergies, like 6 billion euros a year, or $6 billion, maybe 5 billion euros a year in synergy. So I think this is a good one to watch moving forward.
All right, I got to disagree with you on this one, Seth. I don't care about this merger. I honestly think most of these brands, most of them are European based, so they don't even have much access to the US market to begin with. But the ones that do have access to the US market, it seems like most of them are dead men walking in my mind, other than maybe Jeep. I remember actually Daniel Pickett, I'll give him a shout out. He told me one time that Jeep was the only brand in the Fiat Chrysler portfolio that they actually made money on every car that they sold. And you mentioned Chrysler as a I'm not sure the word you used, but as an iconic brand. They only produce 2 models right now, and that's the minivan and the 300. So I have to think that there's going to be some cutting here of not only brands but probably people. The CEO has said that that's not their plan to cut any workers. But if they're going to find some cost synergies, I have to think that might be where some of them are. But there's a lot of overlap in these brands, and I think just looking at them, that I don't know if they all make it over the next few years. They make up 1/4 of the European market, which is substantial. They've got over 50 factories globally now, combined with the 2 companies, and yet they still only have less than 1% of the Chinese market, which is really surprising to me, given the dominance in Europe and the relation and getting products into China. You got any last thoughts on this, Seth?
Yeah, fair enough on some of the brands, although that doesn't mean that it's still not big. And I don't like the name Stellantis, as we talked about. I think that's confusing, and I don't think anybody's going to know what that is, frankly. So.
Yeah, I agree. I don't like the name. It's apparently Latin for to make light with the stars or something similar. But again, you said it sounded something like it was underwater, which I agree. It's got a little bit of an Atlantis touch to it. All right, so the last one here is on industrial production. So we got the data in at the end of last week for the month of December. And industrial production came in really strong, up 1.6%, beating expectations of 50 basis points or 0.5%. Seth, what do you think? You care or not about industrial production coming in pretty high?
I do care. This one is great news for transportation, particularly rail and LTL, because they move a lot of this stuff. And it's also big for rail because a lot of the car loads for rail just turned positive for the first time in 2 years. And over 2020 intermodal carload volumes were driving, weekly rail volumes, but they get a lot better margins and higher revenue per unit on a lot of this industrial and energy type stuff. So I think it's great news for them. And it's also it's good to see the economy broaden out a little bit from just a consumer-led economy that was theoretically stimulus-led to hopefully broadening out and strengthening so that employment can come back down again and people can, we can finally get past this COVID crisis.
Yeah, absolutely. I definitely care about this one. As you said, this is great for LTL and for the rails, but we're going to need another source of freight. You extrapolate it to the bigger economy that we need more to grow other than just consumer led or stimulus led in this case. But I do agree, we do need something else to help pick up this speed. And, the rollout is about to pick up speed. The vaccine rollout is about to pick up speed, as we talked about with the Goldman Sachs data. And so it's not a matter of if, but when we see goods spending and consumer spending revert back to services, which will not benefit freight as much. So I think that this industrial production should act as a support to the freight volumes, and it's definitely great for the freight market and the overall economy. All right, so let's shift gears. So we're going to shift gears to Containergeddon. That is the term that Steve Ferreira has coined this congestion at the port of LA, and we've even seen it at the port of Houston and New Jersey as well. Back when I was first started writing the point of sale newsletters in November, one of the first ones I wrote was titled, "Can Peloton Avoid Disaster This Holiday Season?" And I was questioning that because they were already mounting delays back then in the beginning of November. People were already starting to complain, but that situation has gotten much worse since then. And the results are definitely in on that question. It's a resounding no. Seth, you want to take a moment and go through just a couple of the complaints and delays and what some of the customers are saying about Peloton?
Sure. And, one point I would make, one reason why software and tech companies get higher multiples is because this is a perfect example. Peloton has extraordinary demand for their products, but they're not able to actually produce them and get them in the hands of customers to actually drive revenue. But the basis for this, I think this issue kind of surfaced a couple months ago. So, Peloton didn't have enough bikes and treadmills and inventory to meet demand. So they've been having to run the factories kind of 24/7. And a lot of this stuff was produced in Asia. And so it was then put on container ships and goes across the ocean to LA and Long Beach. And then it either gets put on the rail or on a truck after being drayed over. And then, before it hits the distribution center and the final consumer and final mile. But they've been having massive delays and it's only getting worse. So the gist of this New York Times article was basically they were already so backed up, call it over the past 3 to 6 months, that generally it was taking about 3 months, call it 10 to 12 weeks to get your Peloton. But what's been happening lately is capacity has gotten so tight and bottlenecks all over the place, from the ocean to the rail to trucks, have gotten so tight that people all over the place that ordered these things are then getting notified on the day that they're supposed to be delivered that they're going to be delayed by another month or sometimes even 2 months. And the worst part of this is oftentimes if they're financed through this company called Affirm, which just IPO'd, then they're actually making payments on these bikes and these treadmills, and they're not even getting to benefit from using them. And so what it's resulted in is just a massive sort of explosion in customer anger. And there's been groups on Facebook and Instagram and elsewhere started with very unhappy customers that they're and basically the overriding issue here is there's a blame game going on here. So Peloton is blaming their transportation providers, namely XPO and JB Hunt, in terms of the final mile delivery for some of these mishaps. But it's likely just a messy process. It's likely a combination of, some of the fault probably lies with the manufacturers in China. Some of it probably lies with the ocean container lines. They're having labor shortages at the ports. So it goes all the way down the line, and then it goes to Peloton for not being able to coordinate this whole process and get products delivered to their customers. And then they clearly don't have the technology on the back end to be able to have visibility into the freight and be able to tell their customers, even they have no clue where this stuff is when it's supposed to be delivered.
Yeah, Peloton has probably one of the most fiery bases of loyal customers there are. And I read in that article that the Facebook groups that have been taking on complaints since the middle of the summer, they were usually met with equal backing from proponents of Peloton. But he says now that the complaints have racked up so much, there's just not even enough proponents to fight back on these problems. So this is much bigger than a PR problem for Peloton right now. They're really fighting for a spot in people's lives because we're gyms are closed right now or at limited capacity or you must wear a mask. It's something that people don't want to do, but that's not going to be the case in 6 to 9 months, right? I mean, aren't they fighting tooth and nail to secure a spot in people's lives, and they need to get these things worked out?
Absolutely, and I think this whole process, it's not only damaging from like a brand and a reputational standpoint, because a lot of you and I know transportation, but consumers associate transportation with that's Peloton's fault. The fault lies there. And second of all, I think you touched on it. If they're not able to, if they're not able to immediately capitalize on this demand, it may be permanently lost. And so you may lose customers in terms of getting them into that flywheel and getting them to be loyal customers. And then maybe one day a couple years down the road, they'll replace that Peloton and they'll stay with you. So that demand, if it's not seized now, it could be permanently lost. And I think one of the effects of all this is they announced an acquisition a couple of weeks ago of a factory. I believe it was in North Carolina. So this issue has become so bad in terms of both the manufacturing and the transportation bottlenecks that they're actually bringing a good bit of manufacturing in-house. But that raises the question of, with that acquisition, they'll be taking on a lot of fixed costs, maybe into a deceleration in demand over the next couple of quarters. So it may prove that they overpay for that acquisition, or they may end up with excess capacity if demand does fall, as you were saying.
So let's extrapolate this up a little bit to the overall Containergeddon going on, as Steve calls it. We watched his B2B podcast this morning, and from yesterday actually, and he said this ridiculous stat that I still am having trouble believing. He was talking about back in his day when he was moving freight from Shanghai to, say, Minneapolis, it would take 23 to 26 days. That was typically the range that they would offer people. But now he's saying that range is being offered at 70 days or to 72 days. I mean, talk me through, talk me through this. What are people doing to deal with this? Is it just expanding times for delivery, or, how are retailers dealing with this?
Yeah, I mean, I think that's one reason why you're having trouble seeing the inventory to sales ratio catch up with demand, and why we've argued that the outlook for, regardless of a vaccine, the outlook for transportation demand in the first half of 2021 may be good regardless. And given the stimulus, I think it definitely is going to. But what Steve touched on, that stat, which actually blew my mind as well, I've never been a freight broker or a freight forwarder, but I think it's indicative of, that's almost 3 to 4 times the amount of time. And even worse, think about this, at the actual rates to move things that slowly are up like 400% year over year. I can't remember the China to North American West Coast 40-foot rate is between $4,000 and $5,000, and it was $1,000 last year. And that's just to get you on the boat and for it to take 2 to 3 months for you to get your stuff. So not an ideal environment out there for this. And the other thing that Steve said, and I would recommend his podcast, Navigate B2B. But he talked about basically how, he obviously knows the ocean market extremely well. He was dismissing the notion. So he said it's basically, there's a widespread consensus that the Containergeddon is the term he coined for super high volume, super high rates, and tight capacity on the ocean. A lot of people think that that's just going to end magically after Chinese New Year and peak out. And he thinks, no way. He thinks that goes on at a very strong rate through at least, call it, the next 6 months.
Yeah, I spoke with Sucharita Kodali, a retail analyst at Forrester, and one of the things that she wanted to mention was that the Containergeddon kind of fizzled and it didn't happen. And I was just wondering what data she was looking at. And I think her standpoint there was that from the parcel side of things, not so much containers, but on just the overall transportation congestion that, from deliveries of goods, of e-commerce goods, especially they were really good. Satish and Dell told me that UPS and FedEx had on-time delivery rates of up or at or in line or above their historical averages, above 93%. So
yeah,
go ahead.
I was just going to say, sorry to interrupt, but I had some thoughts there. So if you were to look in Sonar, I write our passport research, the outbound volumes out of both Los Angeles and Ontario, they peaked about 4 months ago, back maybe in September or October. And so one reason why I think those parcels were on time is because a lot of that stuff had already landed on U.S. shores months earlier than normal, given the fact that there was this massive pull forward in both consumer demand and in the holiday shopping period. So if there would have been this mad rush and we had typical timeframes for holiday shopping, it may have been a different story. But without a doubt, I think to say there's been no Containergeddon, all the data that we see, I don't know. I don't know how to agree with that. You're still, I mean, the backlog has actually grown. We were talking about 12 to 15 container ships, for like over the last month or two, sitting out in the San Pedro Bay. Now that's up to like 35. And I heard you last week on Midday Market Update, and you were quoting some stats that I can't recall off the top of my head, but it was basically accelerated demand for all this type of stuff looking forward over the next couple months. So everything we're seeing indicates kind of the opposite. That and by the way, if there weren't one, then you wouldn't see rates up 400% year over year. That's just kind of my read on the situation.
Right. Yeah, rates I think are up a little bit less than that, about 175% year over year, but it's still just ridiculous, and that's just the spot rate.
Yeah.
As Steve would call it, the juvenile rate. Just that's not even going to get you on the ship. That $4,500 right now, you got to add another $1,500 or $2,000 to get you on the ship there. Well, you said something there, but the point I was going to make was that I think retailers did an amazing job. One of those reasons, the reasons that volumes peaked in 3 or 4 months ago was because retailers did a great job being transparent and upfront about their shipping delays, about what would happen if you ordered your goods on December 15th. I think they induced a lot of early shopping from people by warning them and telling them to shop early, and then also by offering their discounts and offering their specials even earlier than typical. I mean, this got kicked off with Amazon's, postponed Prime Day to the first week of October, creating kind of what it was a 75-day elongated peak season where we had parcel and volumes at holiday levels for almost 3 months. But that did great things for the transportation companies. I think transportation providers should be applauding retailers for their ability to smooth out the peak season and drag it along to where they're not so congested and don't have to have so many delays.
Yeah, I think that's a good point. And the other thing that I would say is, given you talked about the goods to services mix shift, right? That we saw a big shift to goods, and what that kind of resulted in was in very steady, elevated demand for, call it, the last 6-7 months, right? And when you have that better visibility into demand patterns, then you're able to actually have better lead time on your ordering, and that results in greater efficiencies all the way down the supply chain. So I think it was a mixture of elevated goods demand, and getting stuff on shore earlier. But definitely, nonetheless, it turned out to be a great holiday season. So you also wrote about the Nrf Holiday Numbers as well. I don't know if we have time, but maybe you could touch on that.
Yeah, I'll just touch on them for a moment. There were 2 surveys by the retail data from the Nrf, as well as a survey that they did last week that just showed that the holiday season was overwhelmingly positive, both from a consumer standpoint and from a retailer standpoint, that, we're able to move goods. I mean, there are obviously some retailers that didn't make it in 2020 that weren't able to sell things at Christmas. But yeah, retail sales came in at a surprising 8.3% year over year. That was up. The Nrf had estimated about 3.5 to 5% growth. So 8.3% was really strong. So yeah, retail sales were strong, as well as 88% of consumers said that they were happier or as happy as they were last year during their shopping experience. So I think retailers and transportation providers did an amazing job. But unfortunately, that is all the time we have today. So I got to send us off. Thanks everybody for paying attention to Great Quarter, guys. We'll be back next week at 3 o'clock live here on FreightWaves TV.